Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's head of U.S. macro strategy. It's Wednesday, October 1st, 2025. Welcome back to the podcast, George.
John, it's been a long time. I've lost track. I'm not even sure if we even recorded something in September. It's been one of those busy months.
Yeah, I could be wrong, but I think our last episode might have been back in July, so it's been we've been remiss.
August, or maybe August. Maybe August.
Was it August? Okay. Well,
Yeah.
regardless, we've been remiss, but not without good reason. We were all over the place. We and you especially were all over the place seeing clients. We held a series of very well received seminars in Boston and New York and Japan, where we sort of explored New York, Boston, and Toronto, where we explored the intersection of U.S. and Japanese markets, and sort of we had some special guests from Tokyo, as you know. And then you were just in non-Japan Asia for over a week, if I'm not mistaken. So I'm thinking that you'll have some good content from those conversations with clients. At the same time, you just published your macro to markets monthly. So why don't we start there? One of the or a couple of the sections in the monthly, talk about your assessment on the economy, on the labor market, as well as on the FOMC. We all know that that the Fed has pivoted and restarted the easing cycle. Given where we are now versus where we were, maybe before Jackson Hole, what's your thinking in terms of what the market's price for the Fed going forward?
Yeah, I think it's also maybe like a good opportunity to kind of work our way backwards, because in this last 6 weeks, things have really changed dramatically. As you kind of described, the Fed has pivoted. We've now started the easing cycle, but in many ways, it's lined up with our house view. Maybe like one or two meetings like later than what we thought. We've been really critical, thinking that the Fed should have started sooner, that they've been behind the curve. That had they known the revisions, both in terms of the monthly revisions for the NFP as well as the large benchmark QCEW revisions that we got at the beginning of September, like if they had all that information at the beginning of summer, they'd be cutting already. So we feel pretty good about the Fed pivoting. They've started with a very kind of cautious stance by only starting up again with 25 versus like last year where they started with 50. I think that those are all the right reasons, all the right ways of doing it. There's a lot of uncertainty still on like inflation. They've been over 4 years above their target, and they're once again starting to cut rates, right? So it's definitely putting them in a really awkward, tough position with the labor market clearly not as strong as they thought it was, and inflation still staying sticky. But yeah, our view, I think, it's largely come to fruition. We think that there's a number of cuts still ahead for 2025. Our convictions start to fade out the further out we go, and that's where I think it gets interesting, because markets have almost like a linear pricing going on with like a total of over 100 basis points of cuts, which we generally agree is the right sort of prescription. It's just a matter of like how it gets executed. There's also the questions around Fed independence. There's questions around who's going to be the next Fed chair. Like, are they going to pass the baton with these levels of rates or lower? So yeah, I think this year we're confident with 2 more cuts at the last 2 meetings, October and December, bringing 25 to 3 cuts, which has basically been our house view, plus or minus 25 basis points for the last year.
Yeah, so it's kind of interesting. You've been ahead of the curve in terms of like the market not pricing enough, and now it seems like you're I don't want to say like behind the curve here, but it seems like with the market pricing so many cuts, you're maybe a little, at the very least, a little less bullish. What do you think? Just as kind of a follow up there, help me understand, what you're thinking about cuts for next year. Like, to some extent, the Fed should be, leaning more dovish, right? You're going to have a new Fed chair appointed by Trump, who presumably will at least share his view that rates should be lower, right now. So the makeup's a bit more dovish. Given what the market's pricing, what are you thinking the Fed will do, in 2026?
Yeah, and that's we'll definitely point for those that are receiving our strategy reports. Figure 5 in our piece really kind of lays out a couple different potential paths where, although our house view is that we think they'll cut 2 more times this year. Next year, cut at every other meeting. But that's really just to kind of give us flexibility, to be honest, around the idea that we think neutral is close to 3. So if they cut 3 times next year and they kind of slow walk into it, that's largely kind of what the linear pricing is showing as well in the SOFR curve and Fed funds strip. But there's obviously other potential avenues of how things may go. We might see the Fed cut two times, and then at the start of next year go on a longer pause, skip September. I'm sorry, skip January, and then come March, maybe inflation data is starting to head higher because of the tariffs, or the economy is doing better, and activity improves.
Right. Yeah, I've heard you say that like some of the pro-growth parts of the big beautiful bill, as example, might start to kick in, and that could help the economy bounce, right?
Exactly. And so like and then also tax returns in April, if small businesses take advantage of the accelerated depreciation, and we see an uptick in activity in Q4, they can get tax cuts and benefits in Q2. So yeah, there's definitely some potential tailwinds that could put the Fed back on the sidelines, because they're like, we're not going to further ease into an accelerating economy, which then brings the potential risk of how that's going to be perceived by the Trump administration. It's also during the transition period to the next chair, whoever that might be. So that could be like an extended pause of like 6 months until the next new Fed chair takes over. In that environment, that's not priced in. Like, market's pricing in very linear thinking towards neutral. And
said another way, it was kind of easy to buy 2-year notes, when they're close to 4%, a little bit less easy to buy them, when they're yielding, 3.5%. A lot of it's in the price already.
Exactly.
But hey, just in the interest of time, I want to get to some other sections of your piece, particularly the section where you discuss Asian FX reserves. This is like, I was like, oh, that's kind of an interesting section, and then I was like, duh, okay, George just spent a week and a half in non-Japan Asia. You probably had you probably have some unique and fresh insight from that trip.
Yeah, exactly. And a lot of this work actually was anticipating, and actually some of the content we pulled together before my trip to try to at least explore and stress test some of these ideas with the clients in Southeast Asia, really kind of thinking through, the last 20, 30 years, there was a large increase in reserves, largely dollars. They've since kind of like the last 5, 10 years really slowed down that reserve growth. Like, what's going on? How does that like change? Like, and also kind of thinking through how are they thinking about recycling of dollars with tariffs. So I thought it was appropriate to kind of like think through that from like a flow reserve connection back to Asia. And so we covered a lot of different grounds, and we're left with a lot more questions than answers. We do think that it's hard to replace the dollar ultimately, but there's new things that are being developed, like a lot of questions around stable coins and like what that might look like, and what's that mean for just general overseas overnight dollar activity, and how that would work. If the tariffs end up with less dollars actually, and some substitution of foreign goods for U.S. goods, that means less dollars leaving the U.S. Like, who's going to be the marginal buyer of treasuries, and just in general, like how are they thinking about the yield curve? So I think it's it's a fascinating time, and it's also lines up with our thesis that we've come full circle, that the reason why reserve accumulation initially started was in reaction to the 1997-1998 Asia financial crisis, where a lot of countries were short funded or underexposed to dollars, and then having dollar liabilities, not being unable to actually defend their currencies. So they built up these large treasure stock of treasuries, and it's an interesting piece. We went through some interesting analysis through FX interventions, and how that also added to their dollar holdings. And now, with the world changing, will there be less need for that, and will Asia currency strengthen, and then less need to buy dollar products?
Yeah, for sure. Very, very, very timely. I mean, like you said, more questions than answered, but that is, kind of the big picture question for the Treasury market. So definitely worth a read to our listeners. And to wrap things up here, George, we would be remiss without discussing the government shutdown. So again, we're recording this podcast on Wednesday, October 1st. The government officially shut down at midnight. Um, I've seen plenty of analysis on kind of previous government shutdowns, how they affect markets. We've talked about it a little bit on the desk. This one feels a little bit different, but tell our listeners more.
Sure, I do think this one's a little bit different, and I think we have to kind of look at it from a few different lenses. One, when is the shutdown taking place? This is at the start of a new fiscal year. It's October 1st. The U.S. government operates on a fiscal calendar starting on October 1st. So it's a new year for the U.S. government's budget, and now they don't have one, so they're waiting on that. It's also the government, if they're abiding by the Byrd rule and only able to use the budget reconciliation process once per fiscal year. Earlier this year, that's how the Big Beautiful Bill was able to pass without a majority of 60 votes. They were able to pass with a simple majority of 51 votes because they were using the budget reconciliation process. They could do that once a year. So technically today would be the start of a new fiscal year. They could do that if they want to, but then they end up using that option very early in the year. And so, the Republican having a majority in the House and Senate put forth a kind of continuing resolution to get the government funded into November. And that didn't pass because the Democrats are looking for some concessions on some of their their focus points around the Affordable Care Act and things like that. And so we're at this kind of loggerhead into the end of the week, assuming that this lingers, which we think it will, if we don't get a deal done before Friday. It probably goes into the weekend. And I think that, obviously has implications for what it means for the disruptive nature to both those that are being impacted because they're not working. And I think we've seen estimates of from the CBO of 750,000 federal employees will be offline per day. And that's a few hundred million in terms of actual lost income until they get paid back eventually. This one is a little bit different because President Trump has been suggesting that some jobs might get actually permanently reduced, and that's never really been how these government shutdowns were handled. So we don't know if those are just leveraged bargaining chips or if he's really going to go through with that. And so that could have implications on actual federal job employment, which would then reduce overall labor data going into the end of the year months. And then if this were to really linger into the survey week of when the various data collection agencies are estimating the NFP number, that also can kind of impact things. And of course, the fact that the government's closed, the actual data releases themselves are not taking place, so that the markets are kind of flying a little bit blind without actual guidance of the jobs data, which we would have gotten the NFP on Friday. But yeah, it's a lot going on. I do think the reason why this time's different because this is the one kind of point in time where the Democrats could at least apply some leverage back against the administration / Congress and the House that's majority Republican to win some concessions on their needs. And so I don't see how this gets resolved that quickly. And so we think as of as a time of recording and what we know as of now, that probably goes into the weekend.
Right, and I think that's where going over the weekend, that's where you think the markets could react negatively, correct? Whether it's risk assets, selling off, or perhaps treasuries catching a flight to quality bid.
Yeah, exactly. So I feel like the time's of the essence, and the timing of the year. It's been an amazing year. Stocks have really bounced back from Liberation Day. It'd be kind of ironic that they start giving back some of the gains because of another kind of government policy snafu.
For sure.
It would be ironic that this takes place at the end of the year, but investors might just decide that it's enough uncertainty, take some chips off the table, and just you see some sort of a reduction in risk appetite until this is resolved. And so yeah, I think this could be the catalyst that people were just waiting for to kind of just take a reset moment.
Yep. Yeah, we were talking about this earlier. Stocks had a spectacular September when many thought they wouldn't, and seasonally they weren't supposed to. Yeah. So certainly at the very least, you're going into this pretty fully priced. Which has to lead to some downside risk.
Exactly.
So George, that was great stuff. I think we covered a ton of ground. But there's a lot more in your macro to markets outlook. I would really encourage our listeners to check it out. It's entitled "It's Still a Reach for a Goldilocks Outcome." And again, if you are still not receiving George's strategy reports, do check out the MUFG research portal at www.mufgresearch.com, where you can find all of your favorite MUFG research, as well as to sign it to have it conveniently delivered directly to your inbox. Great stuff as always, George. Thanks very much.
Thanks, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.